Today is February 16th, 2026. The Shanghai Gold Exchange is closed. The Shanghai Futures Exchange is closed. Both will remain closed until February 23rd, a full 8 days of silence from the world's largest physical silver-consuming nation. And right now, as I am recording this, there is a specific, documented, historically consistent pattern of what Western paper markets do to silver and gold prices during exactly this window. I have the price data going back years. I have the mechanism documented in multiple publicly available sources. I have the current COMEX positioning numbers that tell you who is waiting to use this window and what they need from it. And I have a specific date, February 27th, 11 days from today, that makes what happens in this 8-day window more consequential than any previous Chinese New Year closure in modern silver trading history. Let me show you all of it. Start with the basic architecture of global silver price discovery, because most people who own silver ETFs, or silver mining stocks have no idea how the price they see on their screen is actually formed. There are three primary venues where silver price is established: the London Bullion Market Association, which conducts a daily benchmark auction that sets the global reference price for physical silver; the COMEX in New York, which is the world's dominant paper silver futures market and where the vast majority of global silver price discovery happens on a minute-by-minute basis; and the Shanghai Futures Exchange and Shanghai Gold Exchange, which together represent China's primary venue for both physical silver trading and silver futures. These three venues are interconnected through arbitrage. When prices diverge significantly between London or New York and Shanghai, traders immediately buy in the cheaper market and sell in the more expensive one, closing the gap. That arbitrage mechanism is what normally keeps prices globally coherent. The Shanghai market has been trading at a persistent premium of between 5% and 15% above COMEX prices for months, driven by China's massive industrial demand, which represents approximately 70% of global silver consumption for solar panels, electronics, and manufacturing. That persistent premium is Eastern physical buyers consistently valuing silver above what the Western paper market says it is worth. The arbitrage that should close that gap has not fully closed it, which is itself a signal of physical tightness in the Chinese market. When Shanghai closes, the arbitrage mechanism goes dark, the Eastern physical bid disappears. The counterweight that has been absorbing Western paper selling pressure and preventing deeper price drops is completely absent. And Western paper markets, specifically COMEX, operate for 8 consecutive trading sessions with full control over the global benchmark price and no Eastern physical demand to push back against whatever positioning moves institutional players decide to execute. Here's the documented historical pattern. In a previous Chinese New Year closure period, silver was trading at $22.75 per ounce when Chinese markets closed. During the 8-day holiday window, silver declined to $21.98. When Chinese markets reopened, silver spiked immediately above $23, fully erasing the holiday decline and moving higher within sessions of reopening. The same pattern appeared in gold during the same period. Prices declined during the closure window. Short sellers covered their positions aggressively in the final sessions before Shanghai reopened, as documented by analysts who noted that traders in London and New York knew that if they were still holding large short positions when Chinese buyers returned, they risked significant losses as Eastern demand immediately reasserted itself. The pre-reopening short covering produced price spikes that erased the holiday declines within days. That pattern is not confined to 1 year. It reflects the structural reality of what the Shanghai closure actually creates. 8 days where the most aggressive and best-informed physical buyers in the world are completely absent from the market. 8 days where the short sellers who need price suppression to cover positions, exit trades, or simply profit from downward momentum face no Eastern counterweight. And 8 days where every bearish narrative deployed in Western media lands in a vacuum without the physical demand data from Shanghai to challenge it in real time. Now let me tell you what makes the 2026 closure window categorically different from every previous one, because the context surrounding this specific 8-day period is unlike anything in modern silver trading history. Before Chinese markets closed on Friday, February 14th, the Shanghai silver market was in backwardation. That is a word that appears frequently in these investigations, and it deserves a clear, plain language explanation every time it comes up. Backwardation means the price for immediate delivery of physical silver is higher than the price for delivery in future months. That is the opposite of normal. In a healthy, well-supplied market, the future delivery price is slightly higher than the spot price because the seller needs to be compensated for storage, insurance, and financing costs over the intervening period. When the spot price is higher than the future price, it means buyers need the metal right now more urgently than they need it in 3 months. It means supply is tight enough that people are paying a premium to get metal immediately rather than waiting. It means the physical shortage is real and present, not theoretical and future. Heraeus, the German precious metals refining group that publishes widely cited market analysis, put it directly in their most recent note, published just days before the closure. The silver market is still showing tightness in China, with futures in Shanghai being in backwardation. That is the condition of the physical market at the exact moment the Eastern bid went dark. Not oversupply, not comfortable inventory levels, documented backwardation driven by physical shortage conditions. And now that market is silent for 8 days, while COMEX continues trading paper silver against a registered inventory base that represents a fraction of outstanding paper claims. Let me give you the specific numbers that make this closure window the most watched in years. In January 2026, which is typically a quiet month for COMEX silver activity, 49.4 million ounces of silver were removed from COMEX for physical delivery. That is over 4 times higher than January 2025, 4 times higher in what is historically the slowest delivery month of the year. That withdrawal ate into 26% of COMEX inventory in a single month. In the first 5 trading days of February alone, nearly 19 million ounces were requested for delivery. Holders of contracts with later delivery dates rolled them backward into February, taking nearer delivery instead of later delivery. That is the opposite of normal speculative behavior. Speculators roll forward, physical buyers roll backward. The entities taking those nearer deliveries wanted the metal sooner, not later. As of today, COMEX silver open interest sits at approximately 58,770 contracts, according to the most recently available data. Each contract represents 5,000 ounces. Total paper claims therefore represent approximately 293 million ounces. COMEX registered silver, the metal physically warranted and available for delivery, is sitting at levels that have been drawn down dramatically from their peak. When you compare total paper claims to available registered inventory, the ratio tells you how many paper claims exist for every ounce of deliverable physical metal. That ratio is not comfortable. And February 27th, 11 days from today, is first notice day for March futures contracts. The entities holding March contracts must declare within 11 days whether they intend to stand for physical delivery. Managed money's net speculative position in COMEX silver futures and options, as reported by the CFTC in the most recent commitment of traders' data, is sitting at a notional weight of 713 tons. That sounds substantial until you compare it to where it was. It is 85.1% below the managed money's 1-year average and 78.6% below the 5-year average. Net speculative longs have been decimated. The crash from $121 to current levels wiped out the vast majority of leveraged speculative positioning. What that means is that the silver market is no longer predominantly held by momentum traders and retail speculators who will panic and sell at the first sign of weakness. It is increasingly held by entities that took physical delivery, entities with long time horizons, and a much smaller remaining speculative base that has already been largely shaken out. When the speculative froth has been removed from a market, the remaining holders are structurally stickier. They are harder to push down further. The easy selling has already happened. Now let me walk through the specific tools available during the Shanghai closure window because this is not theoretical. These are documented mechanisms that have been used in previous closure periods and that the data suggests are available again now. The first is narrative deployment without Eastern counter data. Every bearish headline, every falling knife warning, every speculative blow-off reference lands in a Western media environment where the Shanghai physical premium, the Shanghai backwardation data, and the Chinese industrial buyer behavior are all offline. Analysts in London and New York can describe the paper market as reflecting genuine silver oversupply without any real-time data from the world's largest physical consumer contradicting them. The narrative vacuum that the closure creates is not accidental. It is a structural feature of the 8-day window that informed institutional players have historically used precisely because the counter-evidence is temporarily unavailable. The second tool is paper volume without physical absorption. On a normal trading day, when COMEX paper selling drives spot price lower, Shanghai buyers notice the divergence from their local market price and move to arbitrage it. They buy where it is cheap, which is COMEX, and sell where it is expensive, which is Shanghai, closing the gap and providing a floor under COMEX price declines. During the closure, that floor is absent. Paper selling can push COMEX prices lower without triggering the Eastern physical buying response that normally absorbs it. The only buyers left are Western institutional players who make independent decisions about when to step in, and Western retail investors who are reading the falling knife warnings and staying away by design. Ole Hansen at Saxo Bank, one of the most closely watched commodity strategists globally, said it directly. China, a key engine behind the month-long rally in precious metals and selected industrial metals, will remain closed through February 23rd, potentially limiting additional upside in the near term. Limiting upside is the professional analyst's language for what an 8-day absence of the world's largest physical buyer does to a paper-dominated market. The third tool is the pre-notice day positioning window. February 27th is first notice day. Entities holding March contracts must declare delivery intentions by that date. Institutions with large short positions in March contracts have a direct financial interest in seeing paper prices as low as possible before first notice day for two reasons. First, lower prices reduce the potential losses from covering those shorts. Second, lower prices discourage physical delivery standing because at lower prices, fewer entities find physical delivery economically attractive compared to rolling forward and waiting for higher prices. The 8-day Shanghai closure window, positioned immediately before first notice day, is the last clean opportunity to push prices lower before the delivery pressure mechanics begin to operate in full. That is not a coincidence of the calendar. The first notice day structure and the Chinese New Year date have been overlapping in ways that create this exact window for years. Let me be specific about what the short position picture looks like right now. The four largest bullion banks on COMEX collectively hold short positions that represent a massive percentage of annual global silver production. Their structural position has always been short silver because their business model involves selling paper exposure to investors while managing physical inventory at minimal cost. When price rises, they face mark-to-market losses on those short positions. When price falls, they profit. The 8-day window where the world's largest physical buyer is absent creates the maximum duration of low counterweight resistance available in any single period of the year. That the speculative net long position is currently 85% below its one-year average means the remaining longs are less likely to panic sell at lower prices, but the structural short position still benefits from every dollar of downside achieved before February 27th. Now let me address what the physical market outside Shanghai is doing right now, because it is giving you the same signal the Shanghai backwardation was giving before the closure. The SLV Silver ETF, the largest silver-backed exchange-traded fund in the world, shrank last session to its smallest size since the end of January, when the price of silver made what multiple analysts called an unprecedented crash. Physical silver is leaving the ETF. That means authorized participants, the large institutional entities that can create and redeem SLV shares by delivering or withdrawing physical silver, are taking metal out of the ETF rather than putting it in. In a market where paper price was genuinely falling because physical demand had collapsed, you would expect the opposite. You would expect physical silver to be delivered into SLV as the ETF became relatively more attractive versus holding outright. Physical silver leaving SLV during a paper price decline is not a sign of a market repricing lower. It is a sign of physical demand exceeding physical supply at current price levels, with institutions removing metal from every available pool to meet that demand. The Perth Mint in Australia has a 6-week backlog on silver orders. The Royal Canadian Mint reported silver maple sales up 38% year over year in the most recent data. The U.S. Mint sold 1.4 million Silver Eagles in January 2026, the highest January on record. Two Chinese trading platforms, JWR and Wood007, failed during the late January price action and were subsequently shut down by Shenzhen authorities, who banned dealers from using slogans like "Get rich by buying gold." Those platform failures were not caused by insufficient demand for silver. They were caused by insufficient physical silver to meet the demand that the platforms had generated. Platforms fail when they cannot source the underlying asset to fulfill their obligations. When silver trading platforms fail because they cannot source silver, the argument that silver is overpriced and demand has collapsed is not supported by the specific mechanism of their failure. Here is the critical watch point for the next 8 days. The pattern from previous Chinese New Year closure windows shows that Western paper markets push prices lower during the holiday, and then short sellers cover aggressively in the final 1 or 2 trading sessions before Shanghai reopens, because they know the Eastern physical bid will immediately reassert when Chinese markets come back online. That pre-reopening short covering, which has been documented in multiple years, produces the price spikes that erase the holiday decline within sessions. Watch the final 2 trading sessions before February 23rd. If you see sudden, sharp buying pressure in COMEX silver futures on February 21st and 22nd, that is not new bullish fundamentals arriving. That is short sellers exiting before the Eastern buyers return and make those short positions expensive to hold. And then watch February 24th, the first full trading day after Shanghai reopens. The Shanghai premium has been persistent and substantial for months. If that premium reasserts immediately on the 24th, it confirms that nothing in the physical market changed during the 8-day window. The paper price moved, the physical reality did not. That confirmation will be visible in the Shanghai spot price relative to COMEX within hours of the market reopening. It is the single most important data point of the entire post-crash period because it will tell you with real market evidence whether the corrections of the last 3 weeks reflected genuine fundamental deterioration in silver's supply and demand balance or paper market mechanics operating in the absence of the world's largest physical counterweight. February 27th follows 3 days after that reopening, first notice day for March contracts, the 49.4 million ounces withdrawn from COMEX in January, the nearly 19 million ounces requested in the first 5 days of February, the backwardation in Shanghai before it closed, the SLV shrinking as physical is pulled out rather than put in. All of that converges on first notice day 11 days from today. The 8-day window that starts now is the last opportunity before that convergence to change the paper price landscape. The historical pattern says the window gets used. The structural positioning data says who uses it and why. And the February 24th Shanghai reopening premium will tell you in real time whether the physical market agreed with anything the paper market did while it was dark. The closure is official and documented. The Shanghai Gold Exchange published the 2026 holiday schedule in advance, confirmed February 15th through February 23rd. Both the SHFE and SGE are simultaneously offline. 8 trading sessions. No Eastern physical bid. COMEX open. Paper volume continuing. March 1st notice day 11 days out. Shanghai backwardation confirmed before closure. COMEX inventory drawn down 26% in January alone. Net speculative longs 85% below their 1-year average, meaning the market's remaining holders are structural, not momentum driven. Short sellers with billions in paper exposure sitting between today and February 27th, and a historical pattern of pre-reopening short covering that has erased holiday declines within sessions of Chinese markets coming back online. Watch every day of this window. Watch the final 2 sessions before reopening most closely. Watch February 24th as the first real evidence of whether the physical market agrees with what the paper market did while Shanghai was dark. And watch February 27th as the first hard deadline in a delivery sequence that the COMEX inventory data suggests is the most consequential in years. 8 days. Every one of them matters. The data is public, the pattern is documented, the mechanism is known. What happens next is the market's answer to whether the physical shortage that existed before the closure still exists after it. Based on everything available right now, there is no documented evidence that it does not.